Advisory services offered through VestGen Advisors, LLC, an SEC-registered investment advisor. Securities offered through Private Client Services, LLC, member FINRA and SIPC. Private Client Services and VestGen Advisors, LLC are unaffiliated entities. Any information discussed does not constitute investment advice. VestGen Advisors and Private Client Services do not offer tax or legal advice. People of Chicago, welcome to In the Know Radio with Craig Bolanos, co-founder and wealth advisor at VestGen Wealth Partners. You want help from someone that you can trust, someone who knows what it takes to get retired and stay retired. Today, Craig's going to teach you what you need to know. So get ready to learn something that could change your life. Get connected to the show by calling 833-964-PLAN or go to getretiredstayretired.com. And now, here's Craig Bolanos.
Hey, good morning. We're here to help you get retired and stay retired. I want you not to survive retirement. I got to make sure you're thriving in retirement. And that means it's a plan, but it's a plan that's collaborated with you from multidisciplinary professionals, all working under the one roof for one exclusive purpose, which is to give you the freedom from worry. Because when you have the freedom from worry, you get to live more, worry less, and just live the type of lifestyle you've worked your entire life for. 833-964-PLAN. That's 833-964-PLAN. Now, joining me in the studio today again is David. And David, one of the single biggest risks, yes, the biggest risks with a typical retirement portfolio is the stock market going bonkers or acting negatively in the early years of retirement. That's one of the reasons we stand against target date funds. That's one of the reasons that people need a tried and true plan. Talk about why that simplified concept of market down years in the early years of retirement can be devastating for so many, but how do we solve it at VestGen Wealth Partners?
You hit the nail on the head. I mean, we call that sequence of return risk. And maybe we use an extreme example, which would be the 2008 financial crisis. Imagine you retire in 2007, everything is going well, market hits all-time highs in October of 2007, and then 12 months later, the stock market peak to trough is down 51%. If you don't have a plan to where you're going to source your monthly income from, you're probably going to be forced to sell assets at very depressed prices. Now, that's an example of retiring into a really bad market. On the flip side, let's say someone retires in 2010. For the most part, since 2010, the market's just moved up higher. So maybe it's masking some bad withdrawal strategies. But I think at the end of the day, what this gets down to, Craig, maybe the point you're trying to drive home is before you retire, not 2 days, not 2 weeks, not 2 months, but maybe even 2 years before you retire, you should be figuring out from which investments you're going to withdraw money from so that you can clearly earmark that dry powder in your portfolio so that if you do retire and we're trying to deal with tariffs or other geopolitical events, you don't want to be liquidating your securities 20% down or 30% down because you'll never make up the money when that market recovers because you sold at the bottom.
So David, let's break that down and let's be more specific. So you just identified that sequence of return risk, meaning down investment years in the early part of retirement can be devastating for so many. So let's talk about how that can be solved at VestGen, but let's begin by saying how people should not do it because we have a concern over target date funds. I think target date funds like Retire 2030, Retire 2040, they come in different names, Freedom, Life Path, etc. I think they have their place for when we're building wealth because it gives people a starting point for an asset allocation, but it is a less than desirable way for spending your wealth. Why is that?
Right. Well, it would be the same as if money was in a 401k. And that's because when you liquidate those investments, you're liquidating those investments on a pro rata basis, meaning you can't cherry pick what assets in that portfolio get sold. they're just going to sell a little bit of everything at the same time. And we know, depending on what month or what week you do that, you're going to have prices all across the board. I think the more efficient strategy is for those, again, that plan this out to be able to go in and say, look, yes, maybe some of the stocks in my portfolio are down in April, but I have other investments that may have appreciated. Those are the ones that we're going to liquidate so that I can generate the cash flow that I need. So it comes down to being able to create choice in retirement. Where am I going to source the capital from? Because in the growth mode, it probably doesn't matter. When we're accumulating dollars, simple can sometimes be elegant and very efficient. But once we start taking distributions out, you want to maintain control, which means you want to be able to select which investments get liquidated in any particular time period.
Yeah, and David, it's exactly what you said. I'm happy that we're on the same page. Like, I'm looking at a blank 2025 target date fund today, and this 2025 target date fund today happens to be 58% stock, 42% in bonds. And that means when the month of April was terrible, David, was April bad for stock market investors?
It was tough.
It was tough. So if you took a systematic withdrawal from your 2025 fund that has 58% in stock, guess what you did? You sold stocks in the month of April when they were down. You have to avoid that. That's why you need a series of an income plan or buckets of money. David, talk about buckets of money today and how we have a disciplined, systematic, repeatable process for those who want a visual of their cash flow reserve account for the first 5 years, their balanced account and how that's going to work and why it's going to be invested for the next 5 to 10, and then that long-term piece. Create that visual, and I'll talk about how we do the rebalancing to keep it in its proper ingredient weight.
Yeah, so the cash flow account is all about creating permanence and definition, as many defined outcomes as we can, because there's not a lot of things that have, guarantees in retirement. So when I say permanence and definition, that just means we have a simple laddering strategy so that you, the investor, know exactly when your money is coming due, as opposed to just putting it all into a simple bond mutual fund. We don't want to deal with inflation or Fed risks. So we create that simple laddering strategy, and the amount of money that goes in there is customized to you. Do we want to protect the first 2 years of cash flow, the first 3 years, the first 5 years? It varies from family to family. Then we have that second bucket. You kind of said maybe moderate or balanced, right? Purpose of that is we need to continue to keep up with inflation. We want to grow. But the purpose of that account is if there's some unforeseen events, I need to be able to liquidate some assets, and I don't want to have to be forced to sell any of my growth equities.
So, David, what I heard is we set up this cash flow reserve account. We set up individual bonds or target maturity bond funds so that we know exactly when we're getting our principal back. We know exactly how much interest we're collecting. And then when we see horrific things happening in the Middle East, like the bombs falling over Israel and Iran, we don't have to worry about our portfolio because we've got the money tucked away for the next 5 years. And the best part of all, David, is cash flow reserve accounts earn real money today, don't they?
Yeah. If you think about it, it's pretty straightforward. When you buy the investment, you know what the yield to worst is. That's just stockbroker talk for saying if you hold to maturity and the company that issued that security is still in business, right? You get your money back plus the interest. So that's the key is sometimes we need to take these very complicated problems, if you will, and make them simple. And seeing is believing. And if you can see on your statement when your money comes due, that is the peace of mind that a lot of people are looking for in more turbulent times like we experienced in March and April.
Absolutely. So listen, if you want to start creating your own bucket of money approach, you want to learn how to get permanence and definition by having the safe money tucked away in individual bonds and other things that you can too sleep with because you get guaranteed return of principal and yield to maturity, call us today, 833 833-964-PLAN. That's 833-964-PLAN. Connect with us online at getretiredstayretired.com. That's getretiredstayretired.com. Listen, tax season may be in the rearview mirror, but I want you to download our 2025 tax planning guide. You need to be organized getting into the second half of the year to future-proof yourself from your biggest risk. It's not wars. It's not recessions. It's not bear markets. It's taxes in retirement. So download for free our 2025 tax planning guide, getretiredstayretired.com. Well, David, that took care of one bucket, but I'm pretty sure there's two more. So, David, if we've got money tucked away for 3 to 5 years, depending on market conditions, how is bucket number 2 going to be invested? How much money is going to be in there, and what types of investments are very appropriate?
Yeah, so similar strategy. I think bucket number 2 is not designed to shoot the lights out, right? We'll get to that bucket in a second, that higher growth bucket. But that second midterm bucket is well, how are we going to refill our cash flow bucket when it eventually runs out of money? So that might be dividend paying stocks. It could be investment grade bonds, but I'll also throw out there that this is an environment ripe for some non-traditional investments. So in our offerings, there might be some private credit. Depending on tax nature of the account, we might even own some privately held real estate, triple net lease, infrastructure, because we want dividends and growth. But the key is there has to be an outline of where the money's going to come from, not just the first couple of years, but the first 10 years of retirement. And that's what we do really well at VestGen.
So let's get you some visibility into your plan. 833-964-PLAN. GetRetiredStayRetired.com. Talking more about how to live more and worry less after the break.
Radio with Craig Balanas on AM 560 The Answer, where his goal is to pummel you with financial know-how until you say uncle.
So we're talking about laying out your cash flow plan, and it can be done with an income plan. It can be done with the buckets of money. Right now, we're talking about bucket number 2, that intermediate bucket that you're going to use. It has to have an income focus. It's got to have a dividend focus, an interest focus, a payment focus, because it's all about cash flow. So, David, expand for a minute why it's going to be okay to own some cash cows in bucket number 2, because I think owning cash cows, companies with high free cash flow that intersect with dividend growth, that's a big deal to have growing income. I think it's also about diversification and risk control, because when you got cash cows, those great companies of America, those slices of America where the company has these solid balance sheets, these great leaders, what it means to have a wide moat. Maybe you can talk about that. But when we deploy cash cows in bucket number 2 to help offset that income, things do very, very well over the course of a 10-year period.
Yeah, I mean, when we think of those great companies of America, these are companies where they have very strong management teams. You understand what the company does, maybe why they're relevant today, why they'll be relevant in the future. And all of them have one characteristic, which is they grow their dividends. So I think that's the key. Is we're not looking just for the highest dividend yielding stocks. We are looking for stocks that can continue to grow profits. Hence, they will grow their dividends over time, which means that we have a built-in inflation hedge in your portfolio. And I think that's always going to be the core. That type of dividend investing never goes out of favor. Just when you think it's out of favor, it comes back into favor. And I think lots of times on the show, we've mentioned that one of the really unique things about it is as larger companies in growth areas of the market, tech, biotech, healthcare, as those companies have grown, they've also initiated new dividends. So you can still participate in growing themes, but collect some what I call rental income along the way. You know, I also mentioned right before the break that we have to also embrace some maybe non-traditional investments. And so, you know, a lot of times people say, okay, I get it. We're gonna keep it straightforward. We're gonna ladder some high quality fixed income. Sometimes that's not exciting. So people say like, well, what else do we have? What are the other tools in our tool belt? We've talked many times about things like private credit, but I'll throw one other thing out there, which is if we think of real estate. I know real estate's kind of a really touchy subject. Some people think it's a great investment. Some people think it's a more challenging investment. But for those that are investing in their trust accounts, non-qualified accounts, terms that we use, and maybe I'll let you fill in, Craig, things like sale leaseback, where basically a large company sells you their real estate. They want to free up their balance sheet, and then you lease that building right back to them. And doing this on like a triple net lease format, there's higher dividend yields available on that stuff, and your credit risk is pretty low. You're lending to large companies, but the distribution rates on that are 6.5%, 7%. And a lot of that is a return of capital. So if you equate for the taxes, the after-tax returns are very, very competitive today. I'm not suggesting that that should be the core of anybody's investment strategy. But if you're trying to take your investment strategy from a level 101 or 201 to a level 301, those types of investments at the margins make a lot of sense. They give the investor the ability to play into some of these longer term growth thematics like e-commerce and distribution or technology or AI. But instead of buying the equity, you're essentially playing the real estate or the infrastructure part of that. I know that that's something that you're very fond of. What would you add to that? Because I think it's important that people know those investments exist.
So if you're just tuning in, we're talking about the buckets of money and specifically what goes in bucket number 2, which has to be a focus on income generation. And David, one of our top wealth advisors, just mentioned that working in the form of sale leasebacks on triple net leases, where you partner with a global institutional firm that has deep expertise, and you say, what's the benefit of investing in a diversified portfolio, diversified by geography, diversified by tenant, diversified by lease of triple net lease sales leasebacks? Here it is. Number 1, you're going to receive predictable tax advantage income. That's an opportunity over long dated triple net leases, that predictable tax advantaged income. Notice I said tax advantage. Number 2, you get the potential downside mitigation when you're transacting with investment grade or what I call high quality credit worthy tenants. Number 3, you definitely can and do command a yield premium. That's more interest, more yield relative to corporate bonds while owning the underlying property as collateral. I think that's great. And number 4, you get the potential inflation hedge. Given there's rent escalators built into these contracts. So what I do is I keep it really simple, David. If someone said, why might I want to consider partnering with VestGen for a portion of my money on bucket number 2 and diversify into triple net lease sale leasebacks? Simple. If you can seek tax advantaged returns that cluster around 7% historically, why wouldn't you want to consider it for a portion of your money? Because if most people are cash flowing at a rate of 3 to 4, but you're potentially earning 7, if history's our guide and it's the only guide we have, guess what? You're going to meet your cash flow target and you're going to keep up with inflation, which allows you to grow your income over time. 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretired.stay-retired.com. But David, there needs to be more adoption of something else. You talked about it. Sure, we've talked about it every single month now for 6 months, but we're talking about it because it deserves to be revealed. I think alternative investments aren't for everybody, but I think our alternative investments are for a lot of people. And one of the best ways to get started is direct lending, or what you call private credit. David, why do we want to pursue that for a portion of our portfolios?
Yeah. Think of private credit almost in a sense of private bonds, right? So these are bonds that are not traded on an exchange. So oftentimes this is the lending arm of like how private equity deals get done. But if I had to simplify it, you're getting yields that look like high yield corporate bonds with significantly less volatility. So to your point, if you can create a portfolio with distribution rates 7, 8, 9, 10%, but you're only taking 3 to 4% out of your portfolio, you've met your income goal. Plus, you've also created some additional safety net or an inflation hedge. So, with private credit, the formula is pretty straightforward. They take a base interest rate and typically add, another 5% on top of that, which means you're always going to get a premium to the market. Now, again, not without risk, right? There's some illiquidity premium with some of these investments. But again, these investments aren't designed to be the core of your portfolio. These investments are designed to be at the margins to enhance risk-adjusted returns. And if you're an investor that's maybe not super optimistic about the market, but also not very negative, you're kind of in the middle, these are a great tool to have in your tool belt to help generate additional income if you're concerned that the market might just trend sideways right now. Something to definitely take a look at. And I think one of the other things too is, and we'll talk about this in this third bucket, which is the growth bucket, is inflation's still here. So, we had the Fed meeting last week and we heard a lot about inflation, but there's a difference between the inflation rate they talk about on TV and the inflation rate that people feel on a personal level with utility bills, property taxes, food and groceries and stuff like that. And so as we're looking to have these inflation hedges, I always think about it as like an acronym, HELP, right? HELP. So if we're investing in inflation hedges like real estate, or you mentioned, or infrastructure, HELP is number one, H, holding an asset that's backed by the hard asset, the real thing. So not just a stock like a real estate stock, but the actual real estate investment. 2, essential service, things that we need, right? That are going to be here regardless of where the economy is. Number 3, L, the long-term contract, right? We want long-term contracts where we know there's stability from these big companies that we're doing business. And the P of HELP is protected market position or high barriers to entry, what you called, Craig, wide moat, where there's not as much competition. If this is about building ballast in 2025, and it's going to take implementing a lot of these different strategies at the margins to create ballast in every retiree's portfolio moving forward.
Absolutely. Listen, we want you to become the millionaire next door. Maybe you're already the millionaire next door. Let's make sure you stay there. 833-964-PLAN. Go to our website, getretiredstayretired.com. When you're on that website, getretiredstayretired.com, download under useful guides our free publication, Millionaire Next Door. When we come back, important news you need on how to thrive in retirement.
You want more in the know radio? You can't handle more in the know radio. Okay, yeah, you can. And it's on AM 560. The Answer. Welcome back. Here's more with Craig.
Of course you can. That's what we do every single week. So in case you missed it, we've been talking about the 3 buckets of money using a time-tested strategy that's TNT, tested in the trenches. We covered what was appropriate for bucket number 1, those investments that are secure, those investments that have permanence and definition, individual bonds, target date, bond fund, so you know exactly when the bonds are maturing, aka when your principal's coming back to you. We just spent time talking about how to take that income, that equity income focused, using multi-asset classes in bucket number 2, so you can cash flow your way to success. But now what about bucket number 3? And bucket number 3 is so incredibly important because we need to pay homage to the fact that the silent killer in retirement remains inflation. And if we don't have bucket number 3, we won't have the ability to significantly grow our capital base over time. And it's when we grow our capital base over time that we further grow our income over time. And that allows us to keep up with that Cook County property tax bill. That's what allows us to keep up with our ever increasing retiree healthcare premiums. It's that growing capital base, which allows growing income to keep up with life. Life's just expensive. David, talk to us about how we thoughtfully and intentionally craft investments for bucket number 3.
Yeah, well, I think it gets back to what Warren Buffett says, which is you find long-term trends and you throw yourself in front of them. And there's lots of long-term trends with e-commerce, artificial intelligence, healthcare, right? But you got to be in the game. You have to have staying power to have that bucket. But we all know what the stats are. Craig, you mentioned all the time on the show, right? You've got to find a way to, double your income, if not triple your income in retirement, depending on how long you're going to live, because everything keeps getting more expensive. But that long-term bucket, I think, is what some people just don't even allocate to anymore, right? Because they think, hey, I hit this magic age, I've stopped working, I've got to hunker down and get conservative. And while you need to understand where your cash flow is coming, you can't stop investing. We need to invest through retirement. And the only way to generate the money is to make sure that you own a piece of the US market. And dare I say, you own a piece of some other markets today, as we might be on the precipice of a secular shift in investing, where having some dollars outside of the US are accretive to everybody's bottom line.
David, that's so right. So let's grow our way with measured intention to hit our marks and capitalize on those CAGRs, compound annual growth rates, so these portfolios can thrive. But it's so important, David. You and I represent, more often than not, millionaires next door. Those are people who are family-centric. They're comfortable, non-flashy. They got traditional values. And they don't have anything wrong, but they just know that they can and should be doing better. And David, where's the common disconnect between a lot of millionaires next door and their existing financial advisor who sees the world a little bit differently?
Yeah, I think maybe the disconnect is the client is thinking, look, I've already made it to retirement. I already have enough money. And in the back of their mind, they're doing the simple math that says, if I take my portfolio at 4 or 5%, that's probably enough interest to allow me to do what I want to do, and it will help me sleep at night. But on the other side of the table, you might have someone saying, well, you got to grow, right? Like, we've got to take risk. You have enough money. Let's be in the equity markets. Or maybe it's, hey, you've made it, so let's just lock your money into some annuity contract for the next 10 years and you'll never be able to get it out. I think what we should be thinking about is, how can we stay liquid in a lot of investments, but maybe just enhance the yield a little bit so that we can grow above and beyond that, what I call real inflation rate.
So David, what I'm hearing first, though, is we're talking about the disconnect. There are people that have made it. They've worked hard. They've saved. They've invested. They've grown. They've protected. They sold the business. They retired from the company. They know they already have enough money. And they simply say, gee, if I can just earn 5, 6, 7%, I'm going to be good. But they have advisors who overcook them into stocks, or they have advisors that overcommit them to annuities. But you say we can solve it in a better way by diversifying the income streams. Break that down now.
Well, let's just use an example. Let's say someone has $5 million, right? And they need $200,000 a year, right? That's a 4% interest rate, right? So how can we create that stream? Well, look, you could go out and just buy some municipal bonds where the yield is 3.5%, 5.25% tax equivalent yield, or you could buy some corporate bonds that are paying 4.5% or 5%, and it gets the job done. The problem is it gets the job done today, but doesn't grow your income for the future. So the benefit is easy to understand, works right now, but the problem is how are you going to grow? Now, if we take that same structure and we say, how can we improve that a little bit? Well, we already mentioned one thing, right? If we look at some of the real estate opportunities that are out there today, distribution rates at 6.5%, but because they're allowing you to pull through the depreciation or return of capital, the tax equivalent yield for certain investors turns out to be 7.5%, 8.5%, 9% income. What if we had a part of that on top of the easy fixed income? What if we coupled that with some global infrastructure that will also pass through, makes the 4.5% dividend tax equivalent yield of 5.5 to 6, and you get to be in investments where there's long-term contracts, high barriers to entry. It's not about completely shifting someone's investment portfolios. It's about really getting educated on what's out there in upgrading your strategy. And I think the key, and everybody that's grown their wealth to those levels that you mentioned, Craig, knows this. It's about doing it in the most tax efficient manner, right? So do you want to load up on annuities and then have all your kids pay the taxes upon inheritance? Or do you want to buy the real estate now, get the tax advantage income, and let your kids take advantage of the step up in basis? To me, that's real financial planning. That's what we do here. Why haven't you heard about it yet? Because you don't work with a team of advisors that has the intellectual capital to put that all together. See, this is about connecting the dots, connecting the investments to the tax return, to liquidity and your comfort level. And that's what I think that everybody's done a really good job at VestGen doing, is connecting those dots, led by you, Craig.
Thank you, David. 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. We want to make sure that you too have an opportunity to connect the dots. We want to make sure that you too have an opportunity to work with advisors that are multi-custodial with a deep institutional background, that for the right types of accredited investors and qualified clients can achieve these multi-asset class, multi-revenue portfolios to just get the cash flow that you need with the low volatility and senior and secured safety that you're looking for. 833-964-PLAN, get retired, stay retired.com. David, we got to pay some bills. That means we're going to take a commercial break. But David, when we come back, I want to talk about some of the most potentially unique investment opportunities going into the second half of 2025. Stay tuned, everybody. This is information you can't afford to miss. You're listening to Craig and David Bolanos, In the Know Radio, VestGen Wealth Partners on your favorite station, AM 560, The Answer.
Like a dose of knowledge? Good, because Craig is back and about to fill your retirement prescription. Back to In the Know Radio on AM 560. The Answer.
I got to keep it broad, but I'll be as specific as we can. I tease it coming into this segment. What are the top 3 investment ideas that you might not be doing in the second half of 2025? Well, we talked a little bit about one of them when we discussed diversifying your cash flows. But David, I want to pair it with something. There's a lot of people who listen to this radio station who say, you know what? I hate paying taxes, but they pay them anyway because they're citizens. They're citizens. These are people who are vested in this country, but we believe no one should have to pay any more in taxes than they need to. So, David, how do we pair together the unique pricing opportunity that's here right now in tax-free municipal bonds with the very unique asset class you talked about before, which is sale leasebacks on a triple net basis? Break it down.
Yeah, a lot of volatility in the municipal bond market in the first quarter of 2025. But volatility creates opportunity for those that are forward thinking. So you have very attractive after tax yields on high quality municipal bonds, after tax, north of 5% today. But someone might say, hey, north of 5%, I could buy a CD at 4. Yeah, I don't want to pay the taxes, but like, what else can we do? Well, the core needs to be straightforward, right? This is about preserving capital. So we build out the ladder of municipal bonds, but then we might add something like triple net lease. What's a triple net lease? Think about it like this. The tenant pays the taxes, the insurance, and the maintenance, which gives the landlord, right, long-term lease obligations, and they receive the rent without a whole bunch of variability. Now, what's the benefit of those types of strategies? It's that you get a return on capital, which means the dividend yield on those types of real estate investments is not fully taxable to you. So there's the stated yield on paper, around 6.5% today, maybe, but the after-tax yield is higher. So when we pair the two together, that's where we can enhance the returns. We take this from a level 101 to a level 201. Now, I'll take this one step farther to give you an example, right? If you wanted to buy a bond from a very high-rated technology company, they're not going to pay you a lot of money today, right? I mean, Microsoft probably has a higher credit rating than the United States government today. So they're not going to pay you a lot of interest. However, if you're doing a real estate deal where Microsoft is paying you rent, they are going to pay you a lot more than the bond, right? So your credit risk, right, is, are you lending money to a high quality company? Now, I'm not suggesting anyone buys Microsoft or gets in real estate with Microsoft, but what we're saying is these real estate deals are being done with large S&P 500 companies. This is a way you can participate in long-term investment themes as a complement to the equities of those same companies.
833-964-PLAN, 833-964-PLAN. Get retired, stay retired.com. We're just talking about 3 investment ideas for the second half of the year. Number 2, you've heard me say it. I'm going to say it again. I think infrastructure is the new place. I mean, there are studies that show we're talking about a 3.7 trillion. That's 3.7 trillion with a T, annual spend between now and 2040. We're talking a global GDP increase from 3 to 3.5%, all on infrastructure. Why? Because everybody knows that the digitalization of data is the new currency. It is the new gold. And it's not just a US story, it's an everywhere state story that we need more data centers connected to more cell towers, connected to more fiber optic networks, because everyone's going to be using the bots. That's the agentic bots, the generative bots. That's the physical robots in the warehouses. It's all coming, but what powers it? Data centers. And how much electricity or power does a data center take? You can't even believe it. You're in Lombard. It takes all of Lombard to power 2 data centers. It takes the entire city of Chicago proper to power the next gen hyperscale data center that's under development in the state of Texas. Unbelievable. So it's all about digitalization. That is a part of infrastructure. In addition to that, you got to be able to power those data centers. That's going to be district heating and cooling, electric and gas transmission and distribution. Heck, it could be wind, it could be solar, it could be crude oil, it could be anything. The bottom line is it's just energy. And a big part that's going to support all of this is, again, the concept of asset leasing and sale leaseback. So I think you got to make sure you're looking at intelligent ways to get infrastructure into your portfolio for the simple characteristics that, yes, infrastructure is essential services. That means it's more durable. It's more resilient to economic shocks. Infrastructure, like these utilities, consistent cash distributions. Infrastructure, that's inflation hedging because of the pricing power, better diversification, and upside potential. David, what would you add?
Craig, your adopted keyword adopted Florida Panthers just won the Stanley Cup last week, right?
Yep.
To use a hockey analogy, you have to skate to where the puck is going. This is what we're talking about, right? This theme is not going away. It is only growing. So if you think about how this works in your portfolio, find the theme, but you don't have to just be a stock investor. Find the theme, throw yourself in front of it. This is about controlling data, just like it's about controlling energy, just as like it's controlling the flow of goods. Why do people want to take control of the Panama Canal? Why do people want these countries? Why do people want the ports? It's the same thing. It is a race. And in this case, it is a race for data. That is the currency. And you want to be a part of that theme.
833-964-PLAN, 833-964-PLAN. Go out to our website, getretiredstayretired.com. Let's learn about how to pair together those tax-free muni bonds with sale leasebacks on a triple net basis. Let's learn how to diversify further by using infrastructure. And shout out to David, just said it, to all of my hockey friends north of the border in Canada. Yeah, that's right. The Stanley Cup once again resides in America, in free Florida. Shout out to the Panthers. Yeah, got it done again. Awesome. Nothing better. Third idea, gotta say it. It might be a little controversial, but the world is changing its view on storages of value. People said it could never go to 10,000. It did. People said it'll never go to 100,000. It did. Now people say, it's never going to go to 1 million. What if it does? Are you participating in the world's leading digital currency? You know what it is, Bitcoin. I'm not saying you should. I'm not saying you must. Maybe it's all a farce, but the bottom line is it's 16 years old. There's multiple countries themselves who are invested. There's 9 states in the United States that have adopted digital currency to be allowed in their individual state's treasury. There was a change to market accounting this year. We have a digital currency czar in the United States. The current administration is friendly to it. I could go on and on. Don't even get me started on the 11 ETFs, with 4 ETFs that had digital currency IPOs in the last year were the largest IPOs of all time in dollar-denominated assets. Where's the world going? I don't like the concept of a digital dollar, but I understand why people might just use some form of a digital currency like Bitcoin as a form of storage. All I want you to do is learn more. Get educated. You got to make decisions for yourself. But there you have it. Those are 3 very unique ideas that you can use to further diversify your streams of revenue. Further diversify your diversifiers in a world that deems pragmatic optimism. Because let's remember together, just because things haven't turned out as bad as people feared, that is also very different than things being good. And remember, you always get a second chance when it comes to investing to do the right thing. Look at where the market started the year. Look at how bad it got in March and April. Look at where we sit today, closing out the first half of the year. What would you choose to do differently? Well, we stand here to help you fulfill those promises. 833-964-PLAN. Go out to our website, getretiredstayretired.com.
Okay, Windy City, get ready to be blown away with a hefty gust of financial know-how. You're listening to In the Know Radio with Craig Bolanos on AM 560. The Answer.
Well, I don't know about you. I'm excited that we're closing out the first half of the year in a few short days or week from now. That being said, that was a tremendous amount of information on today's show. And as always, these are sincere, actionable ideas that I hope you're using to improve the lives of yourself and loved ones financially. Remember, everyone here at VestGen Wealth Partners, we do not want you to just survive retirement. We want you to thrive in retirement. And most importantly, in a world where you should have pragmatic optimism today, in a world where you should be diversifying all of your diversifiers like we talked about in the show in the second half of the year. Understand there's no room for complacency. Understand the fragility of the system. It's a sound system. It's a great system, but you need to make sure you've got the defensive strategies built into your portfolio so you don't get caught if the tides reverse. Remember, we talked that it was clear in today's show that those Federal Reserve comments, they were less than inspiring. I get why the president's frustrated, but those comments from the Federal Reserve, remember, they were rooted in data. They do see the economy slowing. They do see some of the inflationary price pressures remaining. So use the strategies that we've talked about here to get your bonds in line. Use the strategies we talked about today to get your alternative investments in. Use the strategies we talked about today to make sure you've got the right geography. And you probably want some help. You can and you should. Give us a call. We'll help you implement 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. We're a group of multidisciplinary professionals coming together in the investment advisory space under that strict fiduciary standard, coupled with the cash flow modeling under the CFP standard of care, partnered with the tax saving strategies that you need to diversify away taxes in retirement, strategies and professionals in the estate arena, the retiree healthcare arena, and of course, all things long-term care, the avalanche issue in American financial planning. You want to learn more? You can and you should. GetRetiredStayRetired.com. That's GetRetiredStayRetired.com. Give me a call, 833-964-PLAN. That's 833-964-PLAN. Stay awesome, America.